Hello, everyone, and welcome to the Investor webinar today. We're so excited to have you. We are so grateful for those of us that are returning, but if you're new, we would love to hear from you. So please post new in the chat if this is your first webinar with us. We'd love to hear. All right. I'm just going to pull up some slides here, just a moment. Welcome, Mary. So happy to have you. All right. Hi, Pizzola. So good to see you. Right here. Just give me one moment. You can also post in the chat where you're from. I want to hear where everyone is from. All right, there we go. Thank you for bearing with me. So welcome everybody. I'm going to tell you just a little bit more about the real estate investor, who we are and what we do. Of course, I'm struggling with my slides. There we go. So we have an amazing investor Facebook group. So this is the whole point of this, is to be able to connect with other like-minded women, other like-minded investors like yourselves in a virtual environment. So you can go there at any point and post questions, gain support, and especially get referrals for your local market. That's one of the most powerful things about our Facebook community. We also have investor meetup groups all across the US and Canada. And so we have a forum for virtual connection, but we also have an incredible network for in-person connection in your local market. So definitely make sure to check that out. You can go to our website, therealestateinvestor.com, and just check out our community section. We have resources for agents. So often agents are building the real estate portfolios for others, and we empower through our eXp Realty partnership, empower agents to learn how to invest themselves. And of course, you must know about our free webinars because you're here. We're thrilled to have you 2 times a month. We do virtual events with experts in the industry, sharing valuable experience and strategies to support you. We have our big conference coming up in June in Austin, Texas. Make sure to check it out. And you could even get a free ticket if you qualify for our Stride mentorship program. So you can learn more about the program by going to that QR code just on the slide here. And we hope to see you in Austin. So this is a little bit more about our Stride mentorship program. There's a lot here. You can go to our website to learn more. Okay, I'm going to stop sharing now and I'm going to introduce Anna. So we are thrilled to have you here with us, Anna, to talk about how to get to the closing table and how to fund and structure deals. So a little bit more about Anna. Anna is an impact investor, passionate about creating real estate wealth that lasts and serves a greater purpose and helping others to do the same. She is dedicated to investing for meaningful impact in the lives of her students, investors, and residents. And Anna, I'm going to let you share a little bit more about yourself and then turn it over to you.
Great. So thank you so much for having me. Liz is unable to be here today. She lost her voice. So Tessa is going to help answer questions in the chat, and we will have a Q&A at the end. But for those that don't know me, I have been investing in real estate for about 25 years. I've done about $300 million in multifamily syndications. But before that, I started out just like many of you, flipping houses, turning them into rentals, buying small rental properties. And after about 10 years of really heavy 70, 80 hours a week buying real estate on the side after working full time, helping my husband with his business and raising 4 kids, I had about 100 units in 2018 when I decided to retire from my full-time job and do real estate full-time with syndications and coaching and consulting and speaking. And so I am now a full-time real estate investor and absolutely love what real estate's done for our family and for many, many others. And I'm excited to share with you today some of the ways that can help you to get ahead and to do more deals and make more profitable deals, especially in a time when it seems like there's no deals to be had. to many different investors. So with that, I'm going to go ahead and start my presentation. I've got about 10 slides, and it's going to be a very high level discussion of some different ways that you can do deals and structure deals and think of deals, so that you can decide what really is a good deal for you and how you can make okay deals into really great deals for you. So we're going to talk today for about 30 minutes, and then we will open it up for a Q&A time. So make sure that you're asking questions in the chat as we go, and then I'll look at those when we are done. So with that, I'm going to share my screen and we will get started. Okay. Hopefully everyone can see my screen. If Tessa, if you can't, just let me know. Otherwise, we will get started. Okay. Wonderful. So we're talking about getting to the closing table, creative ways to fund and structure deals. And for anybody that's an investor, sometimes it seems easy and sometimes it seems really hard. And the key to really successful investing is continuing to grow in your ability to find great properties, to find the money to buy them, and then to structure the purchase and financing really to make them into really great deals. And part of that growth is being able to really convince all the different people that you might end up working with in some capacity on your journey, your sellers, lenders, money partners, investors, etc., to accept your vision for a deal and the reason that they should work with you. And so as you grow as an investor, some people go from owning properties completely alone, and then they've got to get really creative with the sellers and with the lenders. And then other people decide to start working with joint venture partners or syndicating big deals like many of us do. And so whatever it is that you're doing, you've got to get really good at what you're doing. And that confidence really only comes by practice, by learning, and then going and taking what you learn and putting it into practice. And so during this time when the economy is doing really well, like an expansion period, like what we've experienced since about 2010 and forward, deals seem to be easy to do. And then you get to a point in the economy where prices are high and interest rates are high, and everybody thinks that it's really hard, and many people give up. And so part of this today is to help you realize that giving up is not what you should do. Hang in there and grow. And so don't give up, get better. You can commit to continual growth and understanding that sometimes in slow markets, it's the time that you're going to grow the most because it forces you to have to think differently and get creative and build that grit and resilience muscle that's going to help you to really be a successful investor over time. So there are many ways to profit on a deal, and I cannot stress this enough. When looking at properties, many people and investors really only think about how much do I pay for the property? Is it overpriced or not? Or am I getting a deal? Or they think about just how much cash flow will it generate? And those two things are very important, but there are many other ways to profit in deals beyond those two factors. And sometimes in different markets, some factors will be easy to accomplish and other things may be hard to accomplish. So, after the Great Recession in 2008 and 2009, deals were really cheap, but it was really hard to find money. Then we've seen where deals have gotten more expensive, but interest rates were so low and it was really easy to find money, but not deals. And now we're kind of in an environment where it's hard to get low price properties and low interest rates. But you've got to be thinking about at all times, not just what do you pay and what's the profit at the front end and how much cash flow you're going to make, but also what about the mortgage pay down? Can you structure deals to where you're really building a lot of equity from the mortgage pay down? What about appreciation? Can you force that appreciation rather than waiting on it to naturally go up? Are there tax savings that make a deal worth doing, even if the cash flow is not incredible or you're not stealing the property in terms of the basis that you're able to buy it at? And so all of these different things are important, and some are more important at different times to each of you as well. So when economies start to change, you really need to think about what are your primary financial goals, and then what are your secondary financial goals. And as an example, most people during their lifetimes are going to prioritize one of three financial goals, either growing your income or cash flow, growing your equity or your wealth, the appreciation in your investments, or preservation of capital, preserve what you've already worked so hard for. And different times in your life, one of those is going to be more important than the other two. And one might be secondary and one might be tertiary. Also, different markets may make it easier to find certain types of deals than others. So, for example, right now we have, CD rates that pay over 5% in many cases. And so it's easier to park money and preserve capital than it is necessarily to find great deals that are going to appreciate or to find cash flowing deals. And so every market gives you a little bit different opportunity. The key is not to give up on opportunity just because your primary goal isn't met. You want to search for deals that meet your primary goal, structure deals to meet your primary financial goal. But then if you can't, or those deals aren't plentiful, then start thinking about working on your secondary goal during those periods in the market cycle. The third thing is, the less money you have personally invested in a deal, the higher cash on cash return you make on those dollars. Usually, today's market is very, very strange. So in the last year to year and a half since the Fed has been raising rates, we actually are in what's called a negative leverage situation. And I'll show you an example of this here during this presentation. But usually if I put less money down and I borrow more money at a good interest rate, my cash on cash return on the money that I actually have invested is better than if I paid all cash for that deal. Right now, money is so much more expensive. So really every dollar that I borrow could reduce my cash on cash return versus if I paid cash. And so you have to understand what the different lending environments do to your money and whether or not debt is going to cause you to make a higher or a lower cash on cash return than if you paid cash. The key is, regardless of the debt situation, the more you can use other people's money rather than your own, the higher your profits are generally going to be, both your cash on your own money and your total return. So learning to structure deals creatively really is what's going to help you to get more deals done and achieve greater profits on your deals, because you know how to structure them creatively. And that's what we're here to talk about today. So we're going to learn how to write offers and structure financing that'll meet your investment return criteria, making mediocre deals into highly profitable deals, even when prices and rates are high. And that is really important to remember. Don't use high prices and high rates as an excuse to think I can't do this or there are no deals. It will be harder to get deals done, but you've got to have tools in the tool belt to even know whether or not there are any good deals out there. So in addition to finding the property, the most important thing that you can do is figure out how to finance it and how your financing can be structured to give you the best opportunity and the best returns. And what I can tell you is that oftentimes a part of my return is generated through financing that is a higher part of my return than the return that I make just based on the purchase itself. So structured financing that is structured really, really well can really make it as much of a 9 or 10% difference in your cash on cash return versus if you didn't know how to structure things creatively. But in certain markets, financing can also be harder than finding deals. And if any of you have been watching the news, lenders are starting to really pull back. And anytime that you start having a difficult economic situation, lenders start to pull back. But once you hit a recession, if we do, and I think we will, banks will get even tighter. And it's usually about 6 months after recession. So knowing that we're in an environment where lending is tightened, they're requiring more money down, higher debt coverage ratios in order to issue loans, along with the higher interest rates, financing is killing a lot of deals. And I believe that it's going to get harder until the economy really bounces back. And because of that, learning creative ways to structure your deals outside of just the traditional bank lending is really, really important to your success in being able to move forward in these fairly challenging time for real estate investors. So many people just simply don't do deals because they lack the money to fund the purchases, they have poor credit, or the banks just say no, along with higher rates. We don't want you women to be those people that stop doing deals and say it's just too hard. We want you to keep moving forward. So The goal is to become a savvy investor. And that means you become good at evaluating every financing opportunity creatively that you can for every deal that you look at, to make bad and even okay deals into really great deals for you. So it's all about getting creative and looking at things in more than one way. So a couple of creative deal structures, which we're going to talk about, and I'm going to touch on these at a very high level just because we only have about 30 minutes today. But this is like a primer, and then we'll open it up for questions. But if you want to, go ahead and take a screenshot of this slide, because it's going to give you some things to think about outside of the traditional way that most people evaluate properties. So most buyers are going to look at a property and they're going to see the sales price, and they're going to see what the rents could be or how much equity they could create. And they're going to go to a lender and put 20% down and get a traditional mortgage, maybe even private money or hard money. But you need to get in the habit of evaluating every deal in multiple different ways. I suggest at least 3 ways for every deal, to see if there's a way you can make a deal work for your financial goals, even when it doesn't seem like a deal on the surface. So once you've gotten really, really experienced, you might be able to look at any property, the price and the net rents, and say, keep or pass, or keep or pass. And most deals today, and I look at deals across the country in multiple different cities and states, different types of deals. I buy vacation rentals, I buy single family homes, I buy small and large multifamily deals, self-storage facilities, etc. So I'm looking at deals all the time. And no matter what the deal is, it is difficult to find deals today with today's prices and interest rates that cash flow. And for most investors that want cash flow, you're just going to see those numbers and hit toss. But before you toss them, I want you to consider different ways that maybe those deals, even with the bank financing rates the way they are, and even with prices, might be able to be structured in a way that can make that deal very highly profitable. And I can tell you that over the last 2 years, I've done several really creative deals that have really boosted my returns versus going to the traditional bank route. So some things I want you to consider right now, especially, is to consider mortgages that have a loan assumption. So if you see a property for sale, you should find out whether it has an agency loan. And what that is a loan backed by a federal government agency. FHA loans, VA loans, USDA loans, CMBS loans, that's commercial mortgage-backed securities on large commercial real estate, and agency loans like Fannie or Freddie deals for multifamily. So oftentimes these agency programs actually have a loan assumption built into the mortgage. And so the seller may not even know that their loan is assumable, but if it is an agency loan, it's usually assumable whether you're going to live in it or not. Now, if you're an investor, sometimes these agencies will make you put 25% down on the property before you can take over the mortgage, instead of just letting you walk right into it and take over it as is. But if you're going to live in it, then you may be able to just take over the mortgage just as is. So keep that in mind, because that's actually one of the easiest things to do, is to assume a low rate mortgage that's stuck at 2.5% to 4%. For more than 80% of agency loans, that's the range of interest rate they're in. And that could be really valuable to you to be able to step in and assume a mortgage rather than having to go to a bank today. The other thing to consider is always putting either less or money down to boost cash flow. So as I mentioned, when interest rates are low, I want to put less of my own money down and borrow as much as I can in order to boost my return. But in today's environment where we have a negative leverage situation, meaning again, that borrowing money actually reduces my turn versus paying cash, then I might need to put more money down on that property in order to get it to cash flow and to hit higher return numbers on my money. Then the next thing is really going all cash with a private money lender or hard money lender, and then looking to refi to a traditional mortgage later. So this is something that works in all markets, but it's still a very viable option for you today. And then the next thing, and this is something I love doing, is asking the bank to get creative. And what I mean by that is there are multiple levers for creative financing that really don't require you to go to a seller or to bring on partners, but there are changes in the bank's underwriting criteria and the way that they issue mortgages that you can request. And these work best with really small local banks. Local banks are those that probably only have a presence in your state or a region of your state. So I'm in central Pennsylvania. We have a couple banks that might have 10 to 14 branches. Sometimes they only have 2 or 3, but they don't go beyond a certain region of central Pennsylvania. They like to lend on assets that are very local. And so if I build a relationship with local banks that still want to do loans, I may be able to get them to make exceptions for me. And the reason is when you go with a large lender like Bank of America or Chase or Wells Fargo, um, or you go even through like Lending Tree or similar, they're using standard underwriting criteria and they're evaluating every person and every deal based on that criteria. And they're not going to make exceptions. But if you go to a local bank, the bank lending decisions are made at the board level. And so if you ask for different things, they'll go to the board and say, we'd like to get a loan, and these are the terms by which we want you to approve this loan for our customer. So the things that I ask the bank for is to allow me, if I have a property, for example, that is really under market in terms of its rents, and because of the purchase price today, those current rents on that deal are not going to support the debt. They're not going to allow my debt coverage ratio to cover my loan payment plus have enough of an extra hedge above that in profits for the bank to be comfortable with. But if I know that in a year I can go in and renovate all those units and bring the rents up, then I'm going to boost my income and boost the amount of money left over to cover that debt. So I might ask the bank to lower their debt coverage ratio requirement for the first year and give me a year based on my track record to come in and boost those rents to where it will cover the debt. So I might ask them to lower that debt coverage ratio. I might ask them to give me a higher LTV loan. So a traditional mortgage with a commercial loan is typically going to be 20% down. And commercial just means you're an investor for the sake of this discussion. It doesn't mean that it's a commercial property necessarily. But if I'm an investor and I want to get a loan, I'm going to get an investment loan. And usually they're going to require 20% down at least. Well, I might say, hey, bank, I have another property that has, $1 million in equity. Will you take a second mortgage on that or a lien against that and let me cross collateralize the property so that I can put less money down today and still qualify for the mortgage? And so I have found banks really willing to do that. If you have another nice property that has some equity in it, it's not likely they're going to give you a higher LTV loan in this environment unless you cross collateralize, but it doesn't hurt to ask. And then the other thing is to ask them for a period of time of interest only payments or IO payments. And that allows me to have a lower mortgage payment while I'm working to renovate my properties, raise the rents, and cut expenses so that I can cover that debt payment. And that can really boost your returns in the first couple of years and get you to the point where your returns are really good after that as well, once the principal payments kick in. So those are things that you can do without going to a seller or without going toward a partnership structure. The next thing you can do is you can talk to sellers about creative ways to do seller financing. So one example might be that I go to a seller and I say, hey, I want to put 10% down on the purchase price, and I want you to hold the note. I want you to be the bank, basically to take installments on the principal of that property. That's called an installment sale. And we'll talk a little bit about how that works. Then I might go to them, and if they say, no, I need the money now, I really can't do seller financing, then you might be able to say, well, what if I put 10% down? I get bank financing for 80%, and then you hold 10% as a seller second. And what that means is they wait to get paid 10% of the purchase price until a future date, and you make them installment payments until you pay them off. They are then in a second lien position. So your first mortgage company is in first lien position on that property. Your seller is in second lien position on that property. And then eventually you pay off that seller and you just have the mortgage left. And both of those situations would allow you to get into a property with 10% down instead of 20% down, which can really boost your returns in many situations. The third thing to think about is something called a master lease with an option to purchase in the future. Some people call them MLOs or master lease options. And essentially what you're doing is you are leasing a property from a seller. That can be a single family home, but oftentimes it's a small to medium sized multifamily home where you're going to basically take over the management of that property. You sign a lease for a flat dollar amount for all of the units, and you pay rent on that lease to the seller for a period of time. And then you can select to rent to whomever you want, to collect whatever rents you want, so that you take control of that property without owning it. And then you can cash flow on that. And then separately, you have an option to purchase that property at a set price in the future. And what that does is it locks up the property so that you have the right of first refusal to buy that property in the future when you can structure the type of debt that you want to. This could be a really powerful option in today's environment where interest rates are high. If you believe that they'll come back down, maybe you can, do the final purchase and close on that property when rates fall. Typically 6 months after a recession is declared is when that happens. And so that's a powerful option as well. I do recommend that if you go with a master lease option, that you work with an attorney in your area, because every state is different. And the one thing I will say is that generally speaking, you want to separate the lease agreement from the option to purchase, because if you have a lease with an option to buy in a single document, one, lenders could call the note if the seller has a note underneath it. And number two, it could give you equitable interest, meaning the seller would have to foreclose on you if you didn't make payments on time, and that can become kind of hairy. So make sure you work with an attorney. Don't just buy a guru online's document and try to go it alone. And then the next thing is a subject to an existing mortgage. So what this is when you go to the seller and they have an existing mortgage and it's not an assumable loan, right? So a mortgage loan assumption, you actually take over the loan, you purchase the property. But there are loans that a seller might have on their property that doesn't have the right to assume that loan. And in that case, many people still purchase the property from the seller. They tell the seller, don't report the sale to your mortgage company. I will take over your mortgage payments and I will do it for you. You can escrow those payments to make the buyer and seller comfortable that an attorney is getting the money from the buyer, taking that payment and making the payment to the lender that underlies that mortgage. But you do have to be very careful, because there is something called a due on sale clause, where if the seller's lender finds out that the property has been sold, they have the right to call that mortgage due. And if they do that, you'd have a certain amount of time to quickly try to refinance that property that you now own in order to pay off the seller's existing mortgages. Some people, and especially gurus that teach subject to, will tell you that it's very rare that lenders call the note. It might be rare, but it is increasing. And I've heard of multiple lenders recently actually calling notes due. I did a subject to on 2 properties where the lender actually did call the note due, not because I didn't structure it properly, but because there was so much debt under that lender from the seller. They had credit card debt and car payments and house payments, all that weren't being paid. I paid off the delinquent amount on the mortgage, but they still had all these other debts. And so the mortgage company basically did some research and figured out that we had bought it subject to and called the note. So we had to refinance it. So just be careful, again, if you're going to look into doing subject to investings. When economies change, a lot of educators that weren't educators before kind of come out of the woodwork. So just make sure that if you're looking into these kind of structures, that you're really working with somebody that's experienced on putting them together, that can lead you the right way into all of the things that could go wrong from a legality and contract standpoint. And so that hey, if I do this, I've got to have mitigation plan B, C, and D in case the loan is called or there's an issue with a master lease option. So working with an attorney, a real estate attorney, is really important when you're dealing with those two options. And then the next two that we're going to talk about is using other people's money. So maybe you still go with a traditional lender, maybe you even have some seller financing, but you're going to use partners to help you fund the deal and the down payment required, the closing costs required, any renovations required. You're going to use partners' money to help you get that done through either joint ventures or through a syndication. And ultimately, you need to think of anything you can possibly imagine that might meet the seller's needs and yours, or the bank's needs and yours, or your partner's needs and yours, that can help you to figure out creatively how to boost your returns and make a deal, a done deal, and a really good deal. Okay, so I'm going to show you just a couple of examples, and feel free to take a picture of this slide as well, on how creative debt structuring using banks or seller financing can make a big difference in your return. So what I've done here is I took $1.5 million purchase price property that generates $100,000 in net operating income every year. And what that means is all my rents less all my expenses is going to generate $100,000 of income to me before I take into consideration a payment on debt. So in this scenario, if I were to purchase that $1.5 million property that made $100,000 a year net, and I paid cash, I would have no loan, no interest rate, no principal and interest payments. I would make $100,000 in cash flow. I would have my whole $1.5 million as the down payment. So $100,000 a year divided by $1.5 million investment equals a 6.67% cash on cash return. That's not terrible. It's better than what a money market or a CD is paying today. But it may not be great either, depending on the risk that's involved in that property that I bought. So I might say, well, what if I found this deal and I considered it cash? Would that be a good enough return for me? If a 6.6% return annualized is good for you for the time and risk involved in that deal, then that is a deal that you would do. But what if you could find a way to boost your returns by using financing? So in the second scenario, I'm going to go to Freddie Mac. And Freddie Mac is one of the agencies for multifamily loans, and they're going to require that I put 25% down. So their loan to value that they'll give me is 75%, meaning a loan amount of 1.125 million, an interest rate of 6% amortized over 30 years with the principal and interest payment, leaves me a payment of $80,940 a year. Well, if I make $100,000 a year on that property net and my loan payment's $80,940, my net cash flow in my pocket's going to be $19,060 per year. My down payment, that 25% of the purchase price, is $375,000. So if I made $19,000 a year divided by a $375,000 investment, all in, closing costs, down payment, etc., my cash on cash return would be 5.08%. So I might ask myself, why would I put $375,000 into a deal that makes me 5.08% when I can have no headache and no risk and go put it in a CD that's paying over 5% today? I probably wouldn't do that deal personally, but you might have a deal that you feel like that's a good enough return for you. The next situation is something I love to do. So it's the same lender, Freddie Mac, same loan, but I'm simply asking them, will you give me 2 years of interest-only payments so that I can lower my mortgage payment while I start to renovate units and increase the income? So if they agree to a 2-year interest only, then in my first 2 years of owning that property, my payment is now cut by about $13,000. So now my annual payment is $67,500. My cash flow is $32,500. And that return over my $375,000 investment is now 8.6%. So that might be a really good structure for a really nice multifamily asset in a quality area, like a Class A to Class B area. It's better than what I'm going to make in a CD, and it's a quality asset that I know is going to be very quality when I'm done working on it. Now we're going to go to a bank lender. So the next one is lender one. That's non-Freddie Mac or Fannie. And let's say they require 30% down, which is pretty common today. And their rate is 6.5%. And they amortize over 20 years. And again, those are very common for commercial loans. Let's say on storage or industrial, where the Fannie and Freddie multifamily loans aren't available. If you pay principal and interest, your payment would be $93,948 a year. You would have cash flow of just over $6,000 a year in your pocket. And on a $450,000 investment, that's only a 1.3% return. That's not very much. And I don't know anyone that would do that deal when they could make 5% today in a CD again. Lender number two, maybe they only make you put 25% down, but their rate's a little bit higher. You're going to be in a negative cash flow position because your payment is going to be higher than your net cash flow, making it a negative return. So that wouldn't work either. And then the last two are examples of seller financing. Both of them are examples where I would put down 10%, so $150,000 on a $1.5 million property. They're both at 6%. Amortized over 30 years, but the first one is principal and interest payments, and the second one is interest only payments. In the first situation, my payment would be $97,128, leaving me just under $3,000 in cash flow. And on a $150,000 down payment, the return is 1.9%. So not very good. But in the last situation, I asked them to make only interest payments. So I'm not going to pay down principal. If you are a cash flow investor, you're not going to care as much about building equity in that property as you are in the cash flow. And so if you do interest only payments out for as long as the seller will let you do that, you could get your payment down. In this situation, the payment would be $81,000, leaving you $19,000 a year in cash flow on a $150,000 down payment. And now it's an 11.7% return property. That's much, much better. And as you can see, the same exact property with the same NOI can get you anywhere from negative cash flow all the way up to 11.7% cash on cash return. The other thing to point out is that all of the loan situations, other than the last one, seller financing and interest only, return a lower percentage return, except for also Freddie Mac interest only, than if you paid all cash. So what this means is that we're in a negative leverage situation, that if you have to make principal and interest payments, the less money you put down, actually the better return that you have. It's only those interest only options that allow you to get a better return in terms of cash on cash than if you were to pay all cash for the whole thing. So remember that you're leveraging your debt, and the way you structure this deal can really boost your cash on cash return versus paying cash in certain economic environments. But when interest rates are high, and generally it's when interest rates are about 6% or higher that you end up with a negative leverage situation. Sometimes when prices are really high, even a 5 or 5.5 could be negative leverage situation. So you need to play with numbers and build a spreadsheet like this to help you to be able to see, are you in a positive or negative leverage situation if you were to borrow money versus paying cash? Then again, if it is negative leverage, the only ways to really adjust for that are you pay less for the property, you put more money down, or you pull these debt levers of asking a lender to give you a longer amortization period, a higher loan to value loan, a better interest rate, or potentially some interest only payments rather than the principal. And each of those are what I'm calling debt levers, or things that when you call the bank or you're talking to a seller, you say, well, what about if you give me a higher LTV loan? Or what about if we do it at this interest rate? Or can you give me 25 or 30-year amortization instead of 20 to give me a higher cash flow? Can you do interest only? All of those different levers will allow you to structure the deal to where you can really make it work. One thing to point out is that different lenders have different underwriting criteria for what they consider a safe loan. Do not let 5 or 6 or 7 or 8 no's from a bank keep you from going after a property that you know is a good deal. True story. I got really stuck after 2009 for a while because the banks just were not lending money to real estate investors, and especially to me because I worked for AIG. AIG was going under in the news every day, and we had business with a lot of debt. And I got 9 no's before I got a 10th yes to buy, my next property after that. Same thing when I asked for a bank to do a second mortgage. I literally got 9 no's for a second mortgage on investment properties before I found the 10th small bank that said yes. So be persistent and realize that lenders are risk averse now. They will get more risk averse going into the next several months, I believe. But you've got to ask anyway. And then you have to be able to back up the numbers and sell your story why you believe so much in this investment and your ability to make this investment profitable, that you want the bank to partner with you and to believe in you and your story. And then that way they can sell it. They can get excited about it. They can understand it. And then they can get their board to approve your loan. Okay. So seller financing. You basically, when you're doing seller financing, you need to be able to create offers for the seller that solve 3 problems. 1, the seller's problem. 2, the property problem. And 3, your problem. Really what that means is, what does the seller need? You've got to find motivated sellers that really have a pressing need for why they want to sell on financing terms. Usually those things are either they're worried about their capital gain. They're trying to sell at the top of the market and they're going to have a huge gain on the sale. Number 2, they might have income property that they need to sell, but they really need the income. Usually in that situation, it's going to work better when CD rates are really low. Right now, a lot of sellers might say, listen, I'm going to sell it outright and I can park my money in a CD for 5%. So unless you can pay me a higher rate that gives me a better income, I won't sell it on seller financing. But you might be able to structure a deal with no down payment that has a higher rate with interest only than what they could get in a CD and get them to want to sell to you to make a higher income. Some are just flat out motivated on sales price. So maybe you need to meet their sales price and use these other financing levers to get your profits up despite paying full price. And others just want cash. And if they just want cash, the only thing that's really going to work is for you to pay cash, either with hard money, your money, private money, or partner money. The second thing is, what's the property problem? What are the benefits that you can bring to that property and solve to make it worth more? Maybe there's under market rents or a property that needs rehab or has really bad tenants. Those property problems might be the seller's motivation for wanting to sell. And you can tell them how you can take over those things to benefit them if they sell it to you. And then 3, the most important to you is you. You need to look at, what are my financial goals and what financial problems am I trying to solve with the properties I'm purchasing? And if you don't have enough money available, then you're going to need to structure a deal where you put very little money down, unless you're going to work with a private or hard money lender or a partner. If you need cash flow, you've got to structure the deal in a way that cash flows. If you really need cash flow and you can't afford to be in a property that doesn't have cash flow, don't buy a property that doesn't cash flow. Wait and buy something that does cash flow. So too many people buy a deal hoping for appreciation in a market that's already really high, when really what they need is cash flow. That would not be a good deal to buy. So you need to make sure that you are laser focused and have blinders onto everything else that isn't your primary financial goal. And then you got to figure out how to structure the deal so that it does cash flow. Or maybe you need equity for your next property. And in that situation, it might be negative cash flow for a while, but you can afford to float the mortgage and all your costs while you renovate that property, force the value up, and then hopefully resell it for a profit. You can structure those deals differently than you would if you needed cash flow. And sometimes your problem is that you have bad credit, or you're out of money, or there's tight lending standards and you need some other way to buy the property, either through a seller or a partner. Okay. The next way that you can structure deals creatively is to consider joint ventures. And with joint ventures, you're not so much focused on how you purchase the property as you are how you bring money to the table. You should always be thinking about all of the above. How can I get the best deal on the property, get it to make the most profits in both monthly and on the back end? And then how can you bring in other partners to help you, but also partners that you can help? So joint ventures is essentially when you have equity partners who are putting money into the deal with you. And generally speaking, I'm going to tell you that joint ventures should be done with 1 to 5 partners. There's some complexity, we'll say, for another discussion about syndications. But essentially, once you have more than about a handful, is the SEC term, about a handful of partners, it's hard to justify that all the partners have an active role in that deal, and therefore you are deemed by the SEC to be selling a security. And that's when you need to do a syndication rather than a joint venture. So the general rule is 1 to 5 total partners, joint ventures. More than that, or if anybody's not going to have an active role, then the syndication is the proper way to do that. So with a joint venture, your partners are putting up money in exchange for ownership. They will help with some or all of the down payment. Usually you want partners who are high net worth, who are liquid, and who have good credit because they can sign on the loans for you. And then you share the profits, the cash flow, and the proceeds at the sale. Remember to select your partners very, 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 very carefully. People with high integrity is the most important thing. You are married to them for the life of the deal. So make sure that you get along. You all have very similar financial and investing goals for the deal, and that you can work well together and that you can trust each other. You will share control on how to run, fund, and when to sell that property in different capacities. So what you will do is you'll create a limited liability partnership or similar legal entity that lays out what percentage ownership each partner has, and it doesn't have to be split equally across all. Oftentimes you can have a higher percentage because you're running and operating the deal primarily with their input and oversight in smaller roles. And so you can determine any share or partnership split on that cash or equity that makes sense and that you all agree to. It's pretty common if you just have one partner and one's a money partner and one's the primary operator to split 50-50, or larger deals. Oftentimes the limited partner, the money partner will maybe take up to 70%, and you as the operator will take 30% if you have no cash in it. And I've structured deals this way, very similar to what we see in syndications. The last thing is syndications. This is team investing or group investing, generally with 6 or more partners. This is pooling funds from multiple investors, and they can be debt partners or equity partners. Oftentimes there's multiple general partners and many, many limited partners. You might be the only general partner and you might have 5 limited partner investors. That would be fine too. But oftentimes the bigger the deal, the more general partners you have so that you can share the work and share the time commitment to those investments. The SEC considers this a security because there are more than a handful, and or there are investors who are completely passive that really don't have a role in control of that deal. There are special rules related to solicitation, meaning you're asking people to invest with you, and qualification to be able to invest in those deals. And so you'll need to work with an SEC attorney to be able to make sure that you're structuring things properly. And in syndications, generally, you are going to manage that property and run it, and then your investments are going to receive periodic payouts of the cash flow and reports showing the financial condition of the property. You should work with an accountant and attorneys because these are complex structures and things need to be tracked very, very carefully. They do require a greater amount of responsibility and time commitment due to how many stakeholders there are and just the legalities and reporting requirements with the SEC and the IRS. And there sometimes is more risk because these are typically larger deals that have more money involved, invested, that do, can take hold of your net worth if you do things wrong. So you have to consider operational risk, reputational risk, the risk of you losing your own net worth if you do something wrong or something goes wrong on the property. That's considered basically the operator taking too much risk or not considering certain liabilities, for example. But it can be very, very lucrative. You make money on acquisition fees up front, asset management fees over time for managing that asset, as well as the cash flow. And generally, you're going to do syndications on value add properties that you're going to hold for about 3 to 5 years that allow investors to keep their money moving and boost their internal rate of return. Although you can do syndications that are held for the long term if everybody agrees to that long-term hold. Okay. So the last thing we're going to talk about right here before I open it up to questions is multifamily syndication structures. And I know a lot of people have questions on this. When you do syndications, every kind of asset is pretty similar. I'm talking about multifamily here because it's what I've done most of, but you could do the same thing on an industrial building, self-storage, car washes, all kinds of things that you see today, ATM funds. So when you do a syndication and you're the operator, you're the person that's running it or the lead sponsor, you are going to have deal level income. So the team that's put together of the general partners makes money in 6 different ways. One, you can take acquisition fees. So it's about 1 to 3% of the purchase price of the property. The larger the deal, the smaller percentage of acquisition fee that's generally accepted by investors. So if it's a really small property, you might charge 3% for putting the deal together. If it's really large, you might charge 1%. And then that would be split amongst the team members that are the general partners. Then you charge an asset management fee. And usually it's about 2% of the gross rental income on the property. You can charge construction management fees depending on how much construction is needed on the properties you're buying. They're typically somewhere between 1 to 10%, 10% meaning a big construction project. Then you can charge fees for disposition and refinancing a deal because there's a lot of work involved in both. You can take a percentage of the cash flow, and most syndications, the general partners share 20 to 30% of the net distributable cash, and the limited partners get 70 to 80% of that net distributable cash. And you can create all kinds of different unique ways to change the percentages that you get, waterfalls, for example. And then on the back end, when you sell, typically your general partner is going to get 20 to 40%. 30 is pretty common. 40 is pretty common for longer term, harder deals. 20% is common when you can't get a really great sales price. And so there's just not as much profit. And then you have to break down all that income across all the different general partners. And so the 5 main things that general partners split duties on are as follows. One is the acquisition team. Who's finding the deal? Who's underwriting the deal? Who's figuring out, the creative financing structure and talking to the lenders, and who's handling the due diligence of that property before you purchase it? That acquisition fee, that acquisition team is generally going to make about 20% of the general partnership. So that could be one person, it could be 2 or 3 people, but generally whatever the amount of fees and income the general partnership gets total, it's then 20% of that goes to the acquisition team. Then you've got your lead sponsor and your key principals. Sometimes the lead sponsor isn't the key principal. The key principal is essentially the one that puts up their net worth to be able to qualify for the loans. Typically, the key principal is going to get 1 to 5% of the loan amount that they are guaranteeing and about 5% of the general partnership. The lead sponsor is the one that's going to handle most of the putting the deal together in its entirety and overseeing every step of the deal from start to finish. And that lead sponsor or lead sponsorship team is generally going to take about 25, somewhere between 10 and 25% of the general partnership. If the lead sponsors are the key principals, then they might charge you, the percentage of the loan amount, and get 5 to 25% of the general partnership. The more they do, the higher percentage they get. And then the third thing is investor relations. So investor relations is the process of getting your investors to invest with you and then continuing to maintain those investors, to report to them, to reach out if they have any questions, to do quarterly webinars or whatnot to keep your investors up to date, help them with their tax forms, etc. So whoever's on the investor relations team that's raising capital and handling investors primarily, generally that team gets about 30% of the general partnership. And then the next thing is the asset management team. Whoever's actually overseeing the property management of that property, oversees the property management company, they're called the asset management, and they usually get 25 to 35% of the general partnership. And then the last thing is hard cost providers. Sometimes you might just need someone that's going to come in and put down the hard money on the property to lock it up under contract, or do what we call pursuit costs, the cost of inspections and appraisals, etc. And that is generally about 5% of the GP. So here is my contact information. My website's reimom.com and my email is info@reimom.com, where you can seek me if you're looking for coaching or deal consulting, deal structure on how to put deals together or evaluate other deals that you might be investing in passively. With that, I'm going to stop the share. I know we don't have as much time for Q&A as we were hoping, but I can go a few minutes over as well if we need to. So Tessa, back to you.
Wonderful. Oh, thank you so much. That was really helpful, especially that last slide of just knowing what's normal, like what is normal, what can I expect? And I'm sure those ranges might go up or down depending on different experience levels and the size of the deal.
Absolutely.
And things of that nature. I have a question here from Noor. Can you have equity partners without the deal being considered a syndication?
You can have equity partners that are considered a joint venture. The syndication is basically the high level rules. And I do want you to always consult an attorney because I'm not an attorney and there's a lot of, complexity here. But generally speaking, once you have more than a handful of investors and or not everybody has a key role, an ongoing role in producing the returns, it's considered a syndication. If you have one investor, but they give you the money and they do nothing else and you run the deal and you're generating return, technically, you're supposed to file a securities filing because you're generating the return for them and they are completely limited and passive and not doing anything. So anytime you're creating a return for someone else and they're not involved in the operations or work to generate that return, it's considered a security. Sometimes you might have a money partner who you don't want to go through a security. Y'all agree that you don't need to. You've got to then make that money partner have voting rights, be able to help you make big decisions, have some level of control, even if they're not in the day-to-day weeds. And then generally you can do a partnership.
So it sounds like there's still ways they're active, but it's very, very light, if you will. So it still can kind of be that equity partner, but just protect you from an SEC.
Absolutely. Yes.
Perspective. Okay, very cool. And I have a question here from Lorianne. Apologies if I'm mispronouncing that. Do you recommend having smaller investment experience before turning to syndications?
Absolutely. One of the things that I'm really cautious about, and I say this as a syndicator, as someone who has spoken at many multifamily events, and just as an investor, is too many conferences and coaching programs tell you that the best way to get started is to go straight to multifamily and straight to syndication. There's tremendous risk in that. Even before the financial environment in which we're in, where interest rates are going up and that's causing values to start to fall, even on great properties, you're basically jumping into handling something you have no experience of handling. And it's big dollars involved. When you have a $10 million property, if you don't know how to run a $100,000 property, you're probably going to make a lot of mistakes. No matter how good and conscientious you are, how honest you are, there's just things that you don't know. So I tell most people, start small, get your feet wet, make your mistakes on small money. That's not going to hurt you. I lost $10,000 on my first flip. If that had been, a $10 million property, I probably would have lost $1 million. And so it would have hurt me a lot longer. So make your mistakes on little money, in my opinion, and partner with other people who are very experienced general partners instead. So maybe you find a deal and you don't have any money and you don't have any experience. If you find an experienced general partner who has a lot of experience, running deals and repositioning them, then you could be part of that acquisition team that's responsible for finding the deal and putting together the funding and doing due diligence, and get about 20% of that general partnership, and then give the other 80% to the operators who are super experienced. If you're raising some of the money, then you would get more, for each role that you're doing. But don't take on a big property without experience. It's really risky, and if you violate SEC rules without even knowing that you violated them, there's jail time and big penalties if you lose investors' money because you did things you didn't know you couldn't do. Something as simple as making a Facebook post saying, I have an investment, do you want to invest, is a violation of SEC securities that can get you in a lot of trouble. So don't go it alone on a big property. It's a really risky thing to do, in my opinion.
that leads me to my next question. You mentioned that you really careful when you partner, because it's like a marriage. You're in it with them for the life of
Yes.
the deal. Do you have any tips or methods that you use? How do you date potential partners before you then marry them?
Yes, that's a really good question. There's so many different things, but essentially you want to think about the fact that most real estate deals are at least a few years long, sometimes, a decade long. And so our excitement to jump into a deal makes us want to partner. And so many partnerships form at a conference, for example, and you say, I like you, you like me, we both want to do multifamily. Let's do one together. And you may find out that one of you has no cash, or one of you has bad credit, or one of you is going through a divorce and your spouse might not, might make it really difficult or try to separate your assets. So you've really got to ask a lot of questions. Dating is meant to ask a lot of questions, to get to know things and to dig deep. And before you create a partnership, you really should make sure that you are so well aligned that you're like a perfect pair of shoes, right? If you have one person going in tennis shoes and one person going in stilettos, it's going to be bumpy and uncomfortable the entire way. So you've got to do what you can to kind of try on those shoes, if you will. And so the key questions that I'm going to ask are questions about, tell me about your experience. Tell me about your, what is your credit? How much cash do you have available to invest in deals? What are your primary financial goals? So if you need cash flow, Tessa, and I don't care about cash flow, I'm more of a risk taker and I want big equity and big payday, then you're going to want to do deals that I'm going to say, I don't want to do that. That's not enough upside. Where you're going to, or I'm going to go, let's take all this risk for something with the backside because I have my financial needs met every month. I don't care about cash flow. Well, if you really can't afford to do anything that has that risk or that doesn't cash flow, then we're going to butt heads about the kinds of deals we do all the time. So talk about things like travel. Who can you travel to the property and how often? How much time do you have available to help run and operate these properties? All kinds of questions like that. Character. Have you been sued for what? You might want to run background checks and credit reports and share with each other. So you've got to get really you got to get comfortable asking uncomfortable questions to really find out, are we a good fit beyond just our personalities?
I love that, getting comfortable asking uncomfortable questions. And we have Denise in the chat. She said same thing, that they did background and credit checks on each other just to make sure they were going into it with their eyes open.
Yes.
This has been such a wonderful presentation. We are at time. We want to be respectful of your calendars, but this was so great, Anna. Thank you, thank you, thank you. I took a bunch of screenshots. I'm sure everyone here did too, to really just go through all these different scenarios and play with the different levers. We're going to be sharing the recording, everyone. There was so much good meaty nuggets in here, so you'll have time to listen to it again, digest, and really take what works for you and take one step forward. Thank you so much.
Thank you, everyone.
Bye-bye.
Bye.